Sam Altman's AI bubble just got exposed live in front of everyone.
How can the company with 13 billion in revenues make 1.4 trillion of spend commitments?
First of all, we might screw it up.
Many of you have been asking for me to make a video on the AI market and the stock market at the moment because AI has been going absolutely crazy. Stocks have been surging to all-time highs, and many people are starting to compare this to the dot-com bubble. Well, in today's video, everyone, I'm going to be going over exactly what led to the stock market crash in 1999 and the dot-com bubble, where it crashed 50 to 75% for many stocks and didn't recover for 13 years. Because many people are just simply looking at the Mag 7. That is Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla. For sure, these stocks have been booming on the AI hype, but did you know many of the stocks in the S&P 500 are actually severely negative? So we definitely need to pay attention and figure out right now where we are in this market bubble so we don't make the same mistakes many people did in the dot-com crash where they lost 75% of their wealth and it didn't recover for decades. So everyone, you know what time it is. Let's get straight into the news, the facts, and the data. Well, okay, first things first, which is what I want to share with you before we get into everything that happened with Sam Altman and AI, is what the greatest investor of all time is doing. So Warren Buffett keeps selling stocks and he's also hoarding cash at record highs. So listen to this, he has been a net seller. In line with Berkshire's recent tendency to raise cash, he noted that Berkshire proved to be a net sell of equities for the 12th straight quarter in a row. Stock sales exceeded stock purchases by $6 billion in the third quarter, he said, while calculating $183 billion in cumulative net sales. And so as we can see here in the headline, everyone, his cash position is nearly approaching $400 billion. So that says that the greatest investor of all time sees that stocks are severely overvalued, and he is very, very patient because those that are patient will be able to buy assets for pennies on the dollar. Now, why tech has been the stocks market superpower, it's also its Achilles heel. Look at this. The top 10 stocks in the S&P 500, led by the AI giants, has surged back to dot-com era levels of dominance. This chart shows the group's equal weighted performance versus the rest of the S&P 500 is approaching the highest level of the early 2000s, and it's a reminder of just how dependent this rally remains on a handful of names. So why, yes, this has been the stock market superpower, it's also going to be the stock market's Achilles heel. If these doesn't matter if all the other stocks crash, but if only a few of these big name stocks crash, well, then we'll see the whole S&P 500 go down with it. Don't believe me? I've got even more proof. So the S&P 500 hit 6,900 on the 29th of October, a new all-time high, but it recorded its weakest breath in history. So what exactly does that mean? Well, almost 80% of the S&P 500 stocks declined today, which is the worst day of market breath ever recorded, while the SPX was making new all-time highs. So again, this is what I've been trying to tell you. Yes, the stock market is going up, but it's really only a few companies. And we saw 80% of companies in the S&P 500 were actually negative. So it says here, the rally's narrowness reflects how concentrated US equity leadership has become. With big tech proving dominant, the gains of a few AI heavyweights are masking widespread weakness, a dynamic that often signals exhaustion in late stage of bull markets. So that's exactly right, everyone. We're seeing these few stocks, they're leading the rally, but what we can learn from history, this shows us that we're normally in the late stage of this bull market. But okay, what you've all come here for, Sam Altman getting exposed, and someone asking a question that Sam Altman did not like and did not like at all. And all could I say is he has a bit of a temper, Sam Altman. And there's been a lot of questions about the whistleblower at OpenAI when he all of a sudden deleted himself, because I can't say the word here on YouTube. There's been some accusations that it wasn't a self-deleting, it was actually a setup, allegedly. So look at this, everyone. Sam Altman was finally asked a big question on OpenAI and its spending spree. So okay, everybody, get your popcorn out and let's listen to what happened.
How can the company with 13 billion in revenues make 1.4 trillion of spend commitments? And you've heard.
Get ready for him to snap.
The criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. Enough. Like, people are.
And we can see here Microsoft CEO is trying to laugh and trying to play it off because he knows this is a very awkward situation, and he's trying to send a signal to Sam, hey, you should probably cool down, just settle down. But he just asked the question we've all wanting to know: how can a company with $13 billion in revenue afford 1.4 trillion in commitments?
I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself, including myself.
People who talk with a lot of like breathless concern about our compute stuff or whatever that would be thrilled to buy shares. So I think we could sell, your shares or anybody else's to some of the people who are making the most noise on Twitter, whatever, about this very quickly.
So you can see he looks a bit uncomfortable here, and he didn't actually end up answering the question. He just said, well, look, you want to sell your shares? Go ahead and sell your shares. I can find another buyer in an instant. But that still doesn't fix the problem. All these companies are doing is something that's borderline illegal and is borderline like a Ponzi scheme where OpenAI says, look, we'll spend 100 billion here on NVIDIA chips, and then NVIDIA's like, yeah, okay, we'll put $100 billion in your company, and they're all just pretty much pledging money to each other, making it look like their revenue is much higher than it really is. And once the market figures this out, how actually their revenue is much lower than they're reporting, and how it's really just all people pumping up each other's shares, well, then that's why this bubble bursting would be so much bigger than before. But Federal Reserve Chairman Jerome Powell was also asked this question: do you think the AI market is in a bubble? So we're going to go over his comments, and then I'll give you guys the real threat, the real bottleneck for AI that many of these companies aren't talking about. So look at this, everyone. Jerome Powell says the AI bubble and the dot-com bust are different. And according to this opinion piece, and I definitely agree, he's wrong. But we're going to give you the facts on why he's wrong. So this is his response. The current AI boom is different in the sense that these companies and the companies that are so highly valued actually have earnings and stuff like that. So you go back to the 90s and the dot-com, these were ideas rather than companies. In other words, the AI boom is not another dot-com style bubble because leading companies today actually have earnings, and it looks like they have a business model and profits. So I don't know about you, but that doesn't seem like a very convincing answer to me. So using Jerome Powell's reasoning, the dot-com bubble was all about fake companies with no businesses consisting of little more than air. But that's not true at all. Some of the biggest companies we have today were around during the dot-com bubble, and they still saw massive stock crashes of 75% or more. But let's dive a bit deeper, everyone. So the dot-com or tech bubble of the late 1990s was not dominated by companies with mere ideas. Yes, of course, there existed and in many cases raised money at ridiculous valuations, but the dominant companies on the stock market back then, even on the tech-dominated NASDAQ, were real companies with real businesses, profits, and sales just as they are today. And so he checked the data from Factsheet, and the most valuable companies on the NASDAQ at the peak of the bubble at the end of February 2000 were tech giants like today, Microsoft, Cisco Systems, Intel, and Sun Microsystems and Texas Instruments. The top 100 on the NASDAQ was dominated by technology companies that were making IT infrastructure and which had businesses, sales, and earnings. The cliche of the time was that the dot-com bubble was a mere era like the California gold rush, and the people who were going to make the most money were those selling picks and shovels to the prospectors. And so this leads to the myth that the dot-com bubble was just companies like pets.com that had no earnings, had no intrinsic value. That's the reason why the market crashed. When no, as we can see here, it was actually legitimate companies that became overhyped, over leveraged. Every time there's a new technology, people get irrational exuberance, and even though the internet would change the world, they were too early and they were simply paying too much. Just because AI will be the future, and I definitely believe it will be, it doesn't mean you just pay whatever price for these companies, because eventually you have to actually make money with these companies. And if their stocks to earning ratio becomes 1,000, it's just simply not a good investment. The biggest dot-com, Yahoo, only very briefly saw its market cap break above 100 billion. That's crazy to be sure, but far behind the giants. And among dot-coms, it's pretty much stood alone. Amazon was valued at a peak of at least 30 billion and 5% of the valuation of Microsoft or Cisco, and less than Walgreens, eBay, and that was less than $20 billion. So as for pets.com, which ended up as a poster child for the dot-com insanity, it raised just $82.5 million in its IPO in February 2000, selling stock at $11, and the stock hit an intraday peak of 14 as there were 35.4 million shares in issue. It meant the company was valued briefly at $500 million. Certainly this was absurd, and Pets.com went bust within a year, but its maximum value was only that of 0.1% of the value of Cisco stock. So again, this destroys the myth that the dot-com bubble was just created by these companies that had no earnings. And we can see Pets.com was just merely 0.1% of some of these major players. So all these people that saying, look, well, it's not a bubble because Nvidia's making so much money, Microsoft's making so much money, OpenAI is going to make so much money. Well, it's just simply a bet. And even Sam Altman admits this.
We do plan for revenue to grow steeply. Revenue is growing steeply. We are taking a forward bet that it's going to continue to go, and how the products we can build around that and the revenue we can generate. We might screw it up. Like, this is the bet that we're making, and we're taking a risk along with that.
And this leads me to my next warning on how bad this crash could get when we look at the dot-com bubble. So from the peak of the bubble at the end of 2000, a period of about 10 months, Microsoft investors lost more than half of their money. Again, these are meant to be the safe plays. By the spring of 2001, merely a year after the bubble peak, Cisco was down 75%. And by the fall of 2000, Intel too had lost 3/4 of its value. So even though Microsoft today is once again among the world's most valuable companies, it took, look at this, 13 years after the dot-com bubble burst before investors even got their money back. And when you factor in inflation, it would be many more years, probably 15 to 16. And this is why I don't like the cookie cutter advice of what most financial YouTubers give, where they say, look, just buy stocks, doesn't matter if it crashes, the market will just keep going back up. Yes, that's been true recently, but that is not normal throughout the longer term history of the stock market. And most of the YouTubers that are giving this advice are young kids in their 20s and 30s, guys similar to my age that have plenty of time for the market to recover. But I have a different audience, an older audience that doesn't have the time to let the market recover over 15 years if they're going to retire very, very soon. Now, he mentions here that yes, they were correct. This is going to be amazing technology, and AI is amazing technology, but they were too early, and you have to figure out what are going to be the winners. A lot of people think OpenAI is because they're the first, but Yahoo was a search engine and they didn't end up being the winner. We had companies like Google that came along and disrupted the market. So okay, now we know that Warren Buffett's selling stocks, he's getting record cash positions. We know that the S&P 500 is not diversifying your investments. It's merely just going to the top 7 stocks that are dominating the index. We've seen Sam Altman has been exposed. We see how overvalued these companies are. But what's really going to be the bottleneck for these AI companies, and what investors may soon realize is the real issue that may stop this innovation in its tracks. Everyone seems to think they just need more chips, more Nvidia chips, and that will solve all those problems, when that's not the case at all. The real issue is energy. So look at this, AI data centers are going to drive 165% power demand. So these AI data centers that they're building all across America and around the world are going to take massive amounts of energy. And let me just put it into perspective. So today's global data center market uses around 55 gigawatts of electricity, with more than half going to cloud computing services. Meanwhile, traditional business applications like email, file storage account for roughly a third, while AI workloads are just 14% of the total. But by 2027, Goldman Sachs expects total consumption to jump to 84 gigawatts. Now, it may be hard to picture that, but this is double the amount of electricity it takes to power New York City. New York City takes about 42 gigawatts of electricity to power the city, when this, by 2027, according to their estimates, will be double that. But it gets even worse, people. By 2030, European data centers alone will need as much electricity as Portugal, Greece, and the Netherlands currently consume combined. So that's not right. Not as much energy as one country, all of them combined. So I know what you may be thinking, right? Well, what happened to, the climate crisis that we're in right now? Well, all these tech billionaires are starting to flip now that it's not making them money, now that it's not popular, and they've got a new way to make much more money. So look at this. Bill Gates says climate crisis won't cause humanity's demise in a call to shift focus to improving lives. So yes, very convenient now that Microsoft is investing hundreds of billions of dollars into these data centers, and he's going to make way more money with his AI grift. than the climate grift. That leads us to the question, well, the power grids are already struggling, so how are the power grids going to be able to support all this demand for energy? They won't. And they're going to have to start creating much more power plants, but that's going to come with a lot of political pressure. And I think that's what will lead to the bottleneck in this industry once investors realize that the innovation is going to pause, once they see their revenues are not climbing as fast as they realized, once they see how overvalued they are and they find some kind of new asset that is very, very good value, well, then they're going to take their profits and go into that new asset class. And that's when we're going to see the bubble burst. And this is a very, very good report here that shows that the real choke point is energy. So everyone, I know what you're thinking. Well, okay, what does this all mean in simple terms? Well, what this means is the reason the stock market is going up so fast is not because the economy is booming and that all businesses are doing great. It's because there's huge hype in just a few select AI company names or companies that are building the infrastructure for AI. Now, I don't think we're at the peak of the bubble just yet. I still think there's a lot of hype and there's a lot of momentum around the AI craze. I think we'll probably have a few more months of this run up until we start to see the bubble pop. But everyone, nobody can predict exactly when this is going to happen. It is purely speculation. If I knew exactly when every single market crash was going to happen, I would be a trillionaire and the world's richest man, and so would you. So just stick to your investment strategy and don't get caught up in FOMO. But everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers that are still watching, thank you all that have been tuning in, showing me much support since I've come back. It's been really great to see all your kind words and kind comments in the comment section. I'm loving being back. And of course, I'll see you all in the next video.